Greetings, fellow investors. First off, I'd like to thank you for signing up for the August 31st online web chat of my advisory, Conrad's Utility Investor. CUI is now entering its third year, and I'm now approaching 30 years advising investors like you on how to take advantage of the wealth-building machine that is utilities and essential services stocks. Online chats like this one have been a consistent and regular feature of my services. The rules are simple. You type in any question or comment on your mind, and when it pops up in the queue, I'll respond just as fast as I can to give you a complete and concise answer. This chat will also be joined by current subscribers of Conrad's Utility Investor, so you'll have the opportunity to see what they're asking. Judging from previous online chats, I'll be fielding queries about everything from prospects of individual stocks and the overall markets to my investment philosophy and recommended strategy and tactics. Some chats have lasted as long as 8 hours, and given the market volatility of the past few months, I'm expecting a long one this time around as well. My promise to you and everyone else on the chat is to keep going until every question is answered. Chances are that's going to be a lot longer than many people will want to hang around for. And that's why we also provide a written transcript of the questions and answers, which we'll post on the Conrad's Utility Investor website under the Events tab after we wrap up. You can also view transcripts for previous chats there. Why do chats of this length when our competitors typically sign off after an hour or two? Well, for one thing, it allows me to provide the highest level of service to readers. That's part of a commitment to superior quality I believe you'll see in the regular monthly issues, the utility roundup updates in between the issues, the alerts we send at times of particular turmoil when immediate action is needed, including 2 last week, and even our free content and income insights. Equally important, I truly get as much out of these chats as anyone. Readers' questions frequently identify areas of interest I need to focus more on. And that also includes companies that I've later added to the now 215 essential services providers that I cover in the Conrad's Utility Investor Utility Report Card. Listening and responding to readers' questions and concerns, I honestly believe has made me a better investment advisor over the years. And now, as both editor and publisher of Conrad's Utility Investor, it's a discipline I intend to follow for many years to come. As I said before, chats are all about what you and other readers want to discuss. But before we get into this one, I'd like to offer a few opening comments. First half earnings reporting season is now behind us, and managements of our coverage universe companies have now updated their guidance for full year 2015. My August 27th Utility Roundup, second quarter earnings season winds down, highlights a series of key big picture takeaways. I'm a firm believer that real actionable trends are best spotted from the ground by analyzing actual developments at individual companies, not from grandiose theories devised 30,000 feet up. And I've identified 7 takeaways from the numbers and guidance of our coverage universe that will shape investors' returns in the second half of 2015 and far beyond. First, the overwhelming majority of companies are on track to either meet or beat management guidance issued at the beginning of this year. That's extraordinary, and it's the best possible sign the best-in-class companies I recommend will keep growing profits and increasing dividends despite the turmoil in the global markets and economy. And I think that's just absolutely a ringing endorsement of why you want to own these stocks. Second, energy price exposure continues to hurt companies' earnings and in some cases dividends. There are some emerging bargains which I point out, but given our forecast of lower oil and gas prices for longer, this is an area where, at least if you're conservative, you want to be very careful. And the same is true with foreign-based utilities that we cover and recommend. These are cheap in the wake of the rising US dollar, but there are pitfalls. There are some countries that are truly coming apart at the seams that you're going to want to avoid. So again, caution is warranted. Now in contrast, company spending on regulated utility networks, those plain old bread and butter utilities, electric companies, gas companies, remains a powerful driver of profits and dividends. And that now includes spending on tax-advantaged solar energy, which a lot of people have talked about as a negative for utilities. It's a profit driver now. And even while this is going on, America's demand for electricity is again picking up after 5 flat to down years. So this is what's in the numbers, folks, and it's again, very bullish. The larger companies in water, electricity, gas distribution, and telecom become, the greater scale they have. And the history of the utility industry is greater scale lifts profitability. You add in the industry's still historically low cost of capital, and you've really got a prescription for a lot more utility mergers. Like Southern Company's all-cash $66 per share bid for a multi-state natural gas utility, AGL Resources, right across town in Atlanta. And this was announced on August 24th. I look for many more potential targets to pop up down the road. I intend to publish a list of them in the September issue, which we're going to post on the 11th of the month. Possibly the biggest question on many investors' minds, probably yours, when it comes to dividend-paying stocks like utilities, is what's going to happen when the U.S. Federal Reserve finally does start raising interest rates. And the conventional wisdom is clearly that we're going to see a massive sell-off. You see it everywhere. Talking heads on CNBC and other news channels, it's pretty much just taken as a given that when the Fed starts tightening, we're going to see these stocks really sell off. But if you take a look at the example, the most recent tightening cycle, something quite different is suggested. Mainly from June 2004 to June 2006, that was the last tightening cycle, the Fed funds rate was increased from 1% to 5.25%. That was quite a tightening cycle. And I haven't heard anybody predicting anything of that magnitude at this point, at least not anytime soon. But over that time, the Dow Jones Utility Average returned nearly 60%, 60%. One of the best 2-year returns in recorded history. And my data goes back before the Second World War. So when the Fed was tightening here, the Dow Jones Utility Average was soaring. And what was the S&P doing? Well, it returned about 15%. So the Dow Jones Utility Average actually outgained the S&P 500 by about a 4-to-1 margin over the last tightening cycle. Not really the kind of opinion that you hear, but again, it's what you will get used to as you read Conrad's Utility Investor. We really take on the conventional wisdom. We don't have the groupthink in our organization. Everybody works pretty hard, and so we really do. We really are able to take advantage of some of these conventional wisdom follies. This time around, the Fed is looking at tightening 6 years plus into an historic bull market. And last time, in 2004 to 2006, the tightening began only about a year and a half into a bull market, and that was the one that started at the end of the 2000-2002 tech wreck. So that's why the results for the broad market could come out a bit differently this time than they did in the previous decade from Fed tightening. But clearly, the false conventional wisdom that Fed action will inevitably lead to deep losses has put a lot of dividend-paying stocks on the bargain counter. And whether it's doom or boom for the S&P, those who buy them now will be treated to high safe yields and reliable dividend growth for many years to come. So those are the kinds of stocks that I'm focusing on now. That's my primary goal at Conrad's Utility Investor. I sincerely hope you'll consider becoming a regular member of my service after this chat. I'm really looking forward to taking your questions. So thank you for your time, and please enjoy the chat.